How to mitigate the risks when investing in real estate. There is no such thing as a risk-free real estate investment. With any return, there is always risk. Successful real estate investors typically know and understand two essential things. The first is the financial objective, or why they are investing in the real estate. For example, is it for future cash flow, preserve equity, generate growth? The second thing successful real estate investors know and understand are the risks associated with achieving their objective and how best to mitigate those risks. There are 5 potential risk categories to mitigate when investing in real estate. First, financing risk. The loan type and structure of the financing can pose a risk depending on the objective. We can't control interest rates, but we can control how we structure the debt. Also, the more financial leverage on a property, the more risk. For example, if our objective is to hold the property for a long time, we want to reduce interest rate risk by fixing the rate in proportion to how long we anticipate owning the property. If our goal is to generate more cash flow, we will reduce the debt structure with a lower loan-to-value ratio. If our objective is to shelter our personal assets, we can't eliminate it, but we can reduce the risk by getting non-recourse debt. The second, market risk. The economy and market conditions will always ebb and flow. We can't eliminate market surprises, but we can anticipate and hedge our risk with different asset classes and locations. For example, if our objective is to preserve equity, we would consider the different market conditions that could occur with a strategy of diversifying our portfolio in various property types and geographical locations to limit the market risk. Third, liquidity risk. The supply and demand for real estate fluctuates, causing liquidity risk. It's all a matter of timing. You may or may not be able to sell a property and liquidate your investment quickly. Usually, immediate liquidity comes at a cost. For example, if our objective is to easily access the equity in the real estate either through refinancing or selling the property, we would reduce the liquidity risk by structuring a loan with no prepayment penalty and invest in an asset class like entry-level single-family homes in a robust market where they can be sold quickly. Fourth, physical geographical risk. There are entitlement and construction risk when developing real estate. They include uncertainty of government approval for permits, the risk of completing a construction project on budget, and the loss of income through the construction period. For example, if our objective is to invest in properties that require little maintenance with no near-term additional investment, the age, condition, the replacement costs of the improvements are all essential factors to consider. Location is another risk factor. For example, an investment in a property with a strategic location, limited supply, strong demand can significantly improve the property value and return on investment. The fifth, specific property type risk. Certain asset classes and tenants are better than others in generating income and providing security. For example, if our objective were to have a consistent, reliable cash flow from a property, we would invest in properties where the tenants are financially stable and the property type is not a special purpose building. A credit tenant like Amazon offers way less risk than a mom and pop retail business. And an entry-level residential housing has less risk than a special purpose building like a church or an indoor ice rink, where the use is limited and unique. Real estate is an excellent investment and a hedge against inflation. However, it does come with risks that need to be considered based on an investor's expertise, tolerance for risk, and overall financial objective. If you have not already subscribed to my YouTube channel, Please subscribe. Thank you for listening and watching, and I'll talk to you again soon.